Morning, everyone. Thank you for joining us for today's webinar, How to Maximize Tax Savings with HSAs, presented by Insurance Empower Retirement and Rea Associates. My name is Imani Fields, and I'll be moderating today's presentation. Before we get started, there are a few housekeeping items to cover. If you have any questions during today's presentation, you may enter them into the chat box on the screen. We will try to answer as many questions as we can at the conclusion of today's presentation. However, to be respectful of your time, we know that we will not be able to get to them all. Therefore, following today's webinar, we will review all questions and send answers via email as soon as we can. Also, if you'd like a copy of today's slides, you'll find that they're available in the handout section of the webinar dashboard on your computer screen. Today's webinar will be given by Paul McEwan, Richard Pipes, and David McClafferty. Paul McEwan is a principal at Rea Associates, where he leads the firm's consulting and administration services. He's responsible for consulting with clients on fiduciary practices related to their qualified retirement, partnering with investment advisors to put their plan practices and helping clients with their retirement plans compliance with federal requirements. With more than 30 years of accounting industry experience, his areas of expertise include retirement plan fiduciary issues, plan compliance, and reporting issues. Richard Pipes, a Kent State University graduate, is the co-owner of Pipes Insurance Service and the head of the Employee Benefits Division. Rick entered the business in 1993 and has since earned the prestigious Life Underwriting Council final designation. Rick has been recognized with the insurance industry with merits such as the National Quality Award, the Century Circle, and the Rangers President's Club. David McClafferty is a regional sales director for Empower Retirement. In his role, he's responsible for new business development in the Great Lakes region. David has 24 years of experience in the retirement services industry and holds a bachelor's degree in economics and an MBA from John Bell University. He currently maintains the FINRA securities registration and the Series 63 state securities license and holds several industry designations. Today's presenters will hone in on how you can use HSAs to maximize tax savings, retain top talent, and more. And I am going to pass it on to you, Paul.
All right. Thank you, Imani. Can you hear me okay?
I can hear you.
All right. Terrific. Well, welcome, everybody. Thank you for joining us this morning. My name is Paul McEwan. I'm with Rea Associates. And this whole webcast was really my inspiration. But I took the inspiration from an article that I read recently. And I think HSAs are an underutilized retirement savings tool. And so my hope is that the one takeaway that everybody has today is that HSAs are not just for health savings. They can also be a really, really good tool to accumulate assets for retirement. And in the audience today, we've invited both employers, clients of Rea Associates, Pipes Insurance, and others, as well as investment advisors that we work with. And my hope is that I can encourage everybody to work in a collaborative way, because I really think working collaboratively as health insurance professionals, investment advisors, and certainly as the plan sponsor or the employer, that we can really provide the greatest amount of value for the participants in these plans. So I regret that the title for today is really how to maximize tax savings with HSAs, because I don't think it really does justice to what it is we're going to be talking about today. Again, I want this to be a multidisciplinary approach. The article that that was kind of the inspiration for today is called, and it has a much better title, HSA, the Ultimate Retirement Savings Tool. And so I have personally benefited from participating in an HSA account or accounts for the last, I'll say, 9 years or so. And I've always kind of taken it for granted, but as I go around talking to clients and others, I find that very often many people, I would say most people, are still not appreciating the ability that HSA, the ability of, or the opportunity they have, I should say, to save for retirement using the HSA account. So this is going to be really a holistic look at incorporating HSAs into the retirement planning process. And if it were just as easy as the plan sponsor adding HSAs to the mix, then this would be a pretty short discussion, and I wouldn't need to have Rick Pipes on the webinar today. But plan design on the health side plays into this considerably, and he's going to have a lot of really good comments for you to consider. And he's probably going to carry the load in terms of the presentation today. But I've also asked Dave McClafferty from Empower, who's a good partner of ours. Empower and Pipes Insurance are real thought leaders in this area of integrating HSAs and 401ks so that they become easier to manage and easier to understand for participants. And so he's going to finish up the webinar for us with tools that Empower has created, quite frankly, utilizing technology to a large extent. But he's also going to, what makes the technology difficult, I think, is HSAs are an individual type of account, and 401k accounts are a group account. And so when you talk about trying to add the HSA account to the platform of the 401k plan, there are a lot of difficult situations you encounter, but Empower is doing it as well as anybody at this point. So I just want to thank those two guys ahead of time for participating today. Really appreciate the fact that you're participating. I think with that little bit of introduction, we have a total of about 13 slides today, folks. So we want this to be pretty discussion oriented. We don't want this to be a lecture just reading down through the slides. Hopefully we're going to have some time at the end for some Q&A. Would encourage anybody to, if you've got questions, to ask your questions. I think there's some chat function I think that Amani probably covered ahead of time. Or if you've got some experiences that you want to cover, or that you just want to mention or share with the group, that would be really great. I've asked both Rick and Dave to share some more stories and some client stories, because I think we all relate to stories better than we do necessarily going down through facts and circumstances. So my role today is really as the CPA of the group. Just I'm going to cover the tax benefits of HSAs, and really I just want to level set a little bit so that we all are kind of starting the discussion from the same level of knowledge. I know many of you, and I don't mean to insult the intelligence, many of you know the ins and outs of the tax benefits of health savings accounts, but I'm going to assume that there are some out there that perhaps this might be the first time. So learning objectives, let's just knock out, I got a couple slides here just in terms of what we want to accomplish. I'll go through the basics of the health savings accounts, the tax advantages primarily, and then I'm going to hand it off to Rick. He's going to talk about why utilization of HSA accounts is still relatively low. Are they misunderstood? What is it? What's a high deductible health plan? What does it mean to be eligible for that? Why do you need one of those in order to have an HSA account? So he'll cover the healthcare plan design aspects. Next slide, Abby. Thank you. And then he'll cover where is the disconnect. I've talked a little bit about it. I've suggested a multidisciplinary approach is best. But where's the disconnect between health plan and retirement plan education? I've suggested, HSAs typically suffer from a health plan focus, and they don't get mentioned very often when the retirement plan is discussed. And generally, you've got different vendors that are handling the different benefits. So Rick and his group are oftentimes talking to their clients about high deductible health plans and HSAs. But then, when the 401k folks and the investment advisors come in, they don't always necessarily mention the HSA accounts. Then we'll talk about, Dave will pick it up from there, and he'll talk about the integration of HSAs and 401k accounts and some of the difficulties in adding investment options for the HSA accounts. Because again, these HSAs are a great opportunity to accumulate assets for retirement. And as you begin to accumulate assets, the question is, how do you invest them, and what are the investment opportunities? And Dave will cover that as well. So let's dive in. Next slide, please. So HSA Tax Basics, and this will go pretty quick, but by far and away, HSAs are the best account to use if you're wanting to accumulate dollars in a very tax-favored way. So typically, we try to get HSAs set up at an employer and then run the contributions, the employee contributions, through in a pre-tax way. And when we do that, because they're health-related contributions, health plan-related contributions, they are payroll tax-free, so that's FICA and Medicare. They are income tax-free, so that's federal and state. The account earned inside the account are also never going to be taxed. And the distributions are not going to be taxed when they come out, as long as you're using them for medical expenses or health insurance premiums. And Rick can talk more about that in a few minutes. The income tax, well, if you don't pull distributions out of your HSA for medical expenses or premiums, then there is going to be an income tax that comes into play. And there's a 20% penalty if you're under the age of 65. So just a couple things to keep in mind. But again, medical expenses, we all know, if you read any sort of financial literature, financial planning literature, medical expenses are going to be a big expense for all of us in retirement. So I really have no concern that in the planning that I'm doing on a personal basis using HSA accounts, that I'll be able to pull that money out in a tax-free way. And then, of course, need to retain the documentation in case of audit. So every time you pull money out of the HSA, like an IRA, you end up getting a 1099, and then you have to be able to document that the distribution was made for medical purposes or a medical expense. Next slide, please. So the contributions are made to an individual account, like an IRA. They are very much, I think a better term might be health independent retirement account, an HIRA, but they shortened it up to HRA. And they follow the employees, so they are physical bank accounts or investment accounts. Contributions, we talked about the employee contributions, but contributions can also be made by the employer. And here I've listed some of the maximums in terms of the contributions for 2020, as well as the catch-up contribution for each spouse, assuming they are at least age 55. So 8,100 would be the maximum for plus an additional 1,000. So I guess it would be 9,100 total for two spouses that were both age 55. HSA accounts, as I mentioned before, are not a group benefit. These are individual accounts. They're based on group benefits, health insurance, high deductible health insurance plan, which is a group benefit, but the HSA account itself is not an individual account, or excuse me, it's not a group account, it's an individual account. Contributions can accumulate year to year. There's no use it or lose it rule. I think HSAs get confused a lot, especially by employees with FSAs, HRAs, MSAs. But really what distinguishes the HSAs is the ability to accumulate contributions from year to year. And there's a real advantage if you don't have to pull money out, if you can write checks for deductibles, particularly in years where health expenses are low. It really gives you an opportunity, gives the participant an opportunity to accumulate significant dollars in these accounts. A little bullet point here, can make distributions in current or future year for expenses in prior years. So what we tell clients is save your receipts because you can always, if you don't pull money out for medical expenses in the current year, you can save those receipts. And if you need the money, even for a non-medical reason, you can use those receipts to take distributions from the HSA. So there's an additional amount of flexibility in terms of being able to pull money out of these accounts in a tax-free format. And obviously, as I mentioned before, distributions are not required. I think a lot of employees, when they're first introduced to health savings accounts, think of these accounts as FSAs, where they're only going to save the amount of the deductible that they possibly might have. And if they have any health expenses, they're going to pull the money out of the HSA account. And that really kind of defeats the long-term purpose of these accounts if you want to use them as a retirement savings accumulation tool. And so I think now I've got do you want to launch the poll question that we've got? Amani or Abby? I'm not sure who's got the controls. I don't even remember what my poll question was at this point. Oh yeah. So I'm trying to get a sense of the audience out there. Does your employer currently offer a high deductible health plan option with HSAs, and three different answers, either no or yes, and it's only employee contributions that you're able to make to the HSA, or yes, in addition to employee contributions, the company also makes a contribution to the HSA. So I'd just be interested in seeing what kind of participation we have in the audience today. And then once we're done with this poll, okay, interesting. Don't know how many responses we had, but pretty even response. I'm encouraged, and maybe Rick, you are too, by the fact that there are a number of employers out there that are making contributions to these HSA accounts. That's very helpful. So you get to this point. There you go. I'm going to introduce Rick, and Rick is going to take us to the next part of the discussion. Hopefully everybody has a good understanding of why HSAs are so powerful from a tax perspective at this point. And Rick, why don't you kind of walk us through how an employer goes about sponsoring an HSA account? How do you add that to the mix, and some other things that obviously you're going to want to think about when you're going through that thought process?
Okay, Paul, thank you. First of all, I appreciate you calling David and I thought leaders. I think my wife would disagree with you on that, but I do feel in this realm of employee benefits, I've been doing it, as some say, since God was a boy, 28 years, and have had the luxury and best experiences working with employers. But I think you'll get the pulse from these next few slides. It's not just the employers, it's the employees and the associates, as I like to call them, because employers need to have buy-in from their associates in order to make these work. And there's a purpose for them. The slide's called who is eligible to contribute. Well, you must be in a high deductible health plan, also known as consumer-driven healthcare is a broad term. In 2004, George Bush and the conservatives at that time, Republicans, this was their answer to healthcare. And frankly, probably the only piece of legislation that actually ever dealt with the cost of healthcare. Even though it didn't deal with the actual reduction of cost, it did deal with people realizing the cost. And the premise was, if we, you have to remember, 2004, PPOs, preferred provider organizations, and HMOs, health maintenance organizations, were very popular. And they lowered the cost of healthcare at the time, but to do so, we gave away healthcare early on, especially in the 90s and 80s. So we were giving a $3, $5, $10 copay. A copay is just a flat dollar amount that you pay for a pharmacy prescription or for a doctor's appointment. But what do we know about what that cost is when we're paying $10 or $3 or $5? We don't know. So the purpose of these was to unveil the cost of healthcare and allow people to be consumers just as they would if they were buying a vehicle or if they are buying anything in their personal situation. So that's why they're designed. That's why they have to have a deductible at a certain height. You're not allowed to have any first dollar benefits. Those are what's called copays. The only rule that you can have previous to deductible is preventative care. We want to keep everybody healthy. So all these plans have 100% coverage on preventative care. But after that, you have to reach your deductible before you see any expenses. Now, the minimum deductible is the one posted here. It's actually a little lower. It's $1,350 a single, and it's double. Excuse me, $13,350 is a single, and $2,700 for the family. Did I get that right? $3,550, $2,800 total. Sorry, Paul, you can help me with that one. But basically, our unembedded deductible. So the $3,550 has to be the single, and the $1,350 has to be a single, and the $2,800 has to be, or the $2,700 has to be a family. We're using $2,800 for the example here, 14 is single. They're unembedded deductibles. So what that means is if you're single on the plan, it's the $1,400. If you have any dependents whatsoever, if you have a spouse, if you have a kid, it's $2,800. It's either or. Then some of these plans pay 100%. So that's the richest health savings plan you can possibly have. The deductibles go way up from there. There's cost sharing afterwards from there. But unembedded, if you hear that term, it's completely different. You can't get an embedded deductible till you get over $2,700 a single. So remember everything.
Hey, Rick.
Yes, sir.
This is Paul. Just to deal with the confusion there, or the possible confusion there in terms of the deductibles. Those are the minimum deductibles you need to have for the plan to be considered high deductible health plan, right? So that you can add an HSA account as part of the overall plan design. The contributions that I mentioned before are the contribution limits for the HSAs themselves. So just wanted to make sure everybody understood that.
Correct. I butchered that deductible amount because I wanted to be specific, but $1,400 a single and $2,800 a family is what most plans are. They're not going any lower than that. Next slide, please. Okay. This is a quote by somebody that I admire myself. Basically, and that's a joke, by the way, but I do have a real passion for getting in and trying to change employee culture. So the quote says, we have clients that have their overall health plan costs decreased. We have large companies who have had a reduction in healthcare costs. They've done it for consecutive years through slow, methodical, cultural changes in their healthcare spending. Associates need to know their behavior directly affects their healthcare premium, out-of-pocket expenses, and personally their raises. They need to be a part of the corporate team and understand their role and process. So understand that when you add these to your plan as an employer, that it isn't going to happen overnight. And we do these through choices, which we'll talk about on the next slide, please. Okay, I always start with employers and I ask about parity. Parity meaning if all things are created equal regarding status of pay. So, for example, we have a large municipality that used to have one plan that was very, very rich, like most municipality plans are. But we were fortunate enough to be able to lead them towards an HSA. And you don't do that by throwing that option as an exclusive option for an employee, even if you're contributing to it, because typically they do not understand the semantics behind it and how to use it, and they just see that they have a higher deductible. So I like to have choices for employees. So what we did in their case is we said, okay, employer, what do you want to spend? What is your cost? What will create parity? Then we added a plan that was richer than that plan that they could buy up for richer coverage. But then we had a health savings account on the back end, and we incented them. We always want to incent them to go that direction through employer contributions into the HSA account, as well as the employees' contributions of premium being lower. So you got to ask yourself questions. What does the employer want to pay? What level of benefit does the employer need to offer to attract good talent? How does your plan compare with others in the industry? And how has your plan performed historically? Don't throw them into shock. And realize that it's going to take years on average for people to migrate towards that health savings account. But if we do it in a way that incents them financially, they'll do so. And it takes a ton of education, and we'll talk about that a little bit too. It's not going to happen overnight. I can tell you that municipality that I'm talking about is all HSA now. They started off with 3 plans, and through about a 5-year plan period, we had so many people on the health savings account, and they incented so well that they're 100% health savings accounts. Now, I'll bet most of you don't know any municipalities that have all HSA accounts because of the benefit level being so rich typically. But the benefit level is still rich. It's just that we incented it properly and help them make good choices now with their healthcare spending, since they actually get to see what the cost of healthcare is. Next slide, please. Okay, one of my favorite terms is this is a process, not an event. Again, going back to who is eligible, you're not allowed to have secondary coverage if you are the account holder. So what's that mean? I'm an associate of a company that has a health savings account. I have the account through one of the services we're going to talk about. At that point in time, I'm not allowed to be on my spouse's plan that is a not qualified health savings account. Let's say I'm 65 and I'm still actively at work. I'm not allowed to have plan Part A of Medicare or Part B of Medicare. Now, what people don't know is you technically can go in and physically waive those coverages until you start receiving Social Security. Then you have to take them. But at that point in time, you can't contribute to your health savings account. Now, it's important to remember that your plan is separate than your account. The IRS is separate than the health insurance company. So you could be on that high deductible plan, but you would not be able to contribute to the HSA account and get the tax incentives if you have secondary coverage. So you can see for this reason alone, as well as what does your spouse's plan cost versus your employer's plan cost, versus is my spouse a veteran? Is there veterans coverage? You can see how customized this can be. So if you're talking to an employer group and you're speaking in generalities, it's not going to apply to each person specifically. So it takes a lot of education. It's not a commercial for our firm, but our firm does a lot of employee education. You do it through group meetings. You do it through personalized health insurance consultations. So you may be on site working with that employer and being available for personal meetings with them or their spouse. Sometimes those appointments are at the office because confidentiality reasons. The spouse wants to be a part of these meetings. You can do them virtually, as we're doing today on a Zoom. Videos going on in their lunchrooms, education pieces. So you have to drip on them over time and understand until they're comfortable and until they understand why they're doing it. It may not appeal to them right away. Until their peers do it, it may not appeal to them. But I've never had anybody on the health savings account that hasn't been happy about it if it's designed properly and switched back to the traditional type plans because of all the reasons we're talking about. Next slide, please. So I like to refer, and how does this integrate with what Paul and David do? I call it your healthcare retirement plan. You're never going to regret putting money into this for all the reasons Paul mentioned and that David's going to mention. It is the best place to put money. It's one of the easier places to get out. It helps bulletproof you or your associates as they get towards retirement during those difficult ages to find coverage between age 55, 65, for example. The more money you have in this, the more insulated you are from employee contributions going up or optional plan designs. B, you retire and you have to go buy your own health insurance and you're not 65 yet. There's all types of ways this is going to insulate you. Remember, it's always your money. Your account is always your account. So long-term, the account itself can be used for a lot of things that will help you. It can be used for premiums, for example, or COBRA. It cannot be used for Medicare supplement premiums when you retire. But what I tell people is right now you can choose from a slew of Medicare supplement plans, from what's called an Advantage plan to a traditional supplement plan. One might be $300, $400 a month. One might be $30 a month. The difference is what you're going to spend on an ongoing basis. So if I have that money in my account, it may allow me to buy the lower cost plan and then use this account to spend on those items for the more out-of-pocket expenses on an Advantage plan. Remember as well as what Paul said, if I've kept my receipts for the last 10 years and I have a large amount of money in there and I need money for something non-medical, as long as I've kept that receipt, I can use it. So I'm not going to tell you to go buy a boat with it because you're probably going to need it for something else. But if you've kept your receipts, you could do so. Braces are a qualified item, and I have twins, and my braces for my twins were $9,000. That's a receipt that I can reimburse you for. Another thing at retirement, it's based on a gradual scale based on your age, but you can use this for long-term care premiums. So I'll let the accountants and the tax advisors tell you how cool that is. But you can use it for your premium, and then if it's a qualified long-term care policy, that's tax-free as well when received. So that's probably one of the better features that people aren't using in their health savings account for long-term care premiums. So again, you can't regret putting money into these. An employer can use this to help change their culture, to get their associates to have buy-in, to understand that as healthcare costs go up, if they're not making good choices, if we aren't teaching them about the difference of cost between a doctor's visit, an urgent care, an emergency room, the difference between a generic cost, and all the education that goes in. But now I have the policy with a high deductible that they actually can save on those costs by making good decisions. You can change a corporate culture on their healthcare expense, and then their expenses go down, which directly influences those associates out of pocket for their premiums, have a richer plan design, and have maybe higher raises. With that, go ahead and if you don't mind putting the poll question up. The question says what are employees usually most concerned about? The cost of employee premium contributions or the plan design? Let's say I have a plan design with a really high deductible and a really high out-of-pocket maximum, the most they can spend. What are they most concerned about? I'll go ahead and get your answers if they came in that quickly. Is there any, they're not answering it probably because it's a trick question? Okay. Actually, the premium contributions. I'm glad to get that information. My answer is it depends upon their situation. But you are right. The majority of employees are not using your plan. They're not unhealthy and they're not maximizing their medical expenses. So by giving them choices, they're customizing plans based on their needs. But most of them do want to keep their costs down. So everybody has something to gain by being better consumers within a corporate population, because the better my claims are, the better my premiums are, the lower my contributions are, and frankly, the better my plan designs can be. So that's the buy-in we have to get from our associates. That's where it takes a lot of education, and that's why a health savings account is the perfect vehicle to help people be better consumers of their health plan. Last of my
Hey, Rick, I
Yeah.
appreciate your comments. I talked about kind of established why the HSAs are such a great tool from a tax perspective. You talked about the opportunity from a plan design perspective to really control costs and drive costs down. I think the last piece that we want to talk about, and what Dave McClafferty is going to talk about right now, is the ability for participants to really integrate the 401k plan and the HSA plan, so that you can begin to have to work on HSAs and 401k in a very collaborative way with both sides of the house, both the health insurance vendor as well as the investment, the 401k investment advisor. So Dave, why don't you share some of the tools that Empower's put together, and some of the thoughts and where you see the industry heading in the future. I think you're on mute, Dave.
Oh, thank you. All right, so Paul, do you want me to hop right into the WebEx, or do you want me to cover some of the slides that we had earlier? Now you're on mute.
It's up to you, Dave. We've already taken the screen down, so you have control if you want to start your portion of the program.
Okay. Sure, certainly. So, one of the challenges with the HSA, we've mentioned a number of times that participants kind of confuse the HSAs with FSAs, that's use it or lose it type scenario, and they're not really seeing it necessarily as a savings vehicle for retirement savings. And one of the comments that Paul mentioned right out the gate is it's one of the most unutilized savings vehicles for participants, specifically because the biggest concern for most participants during retirement years is going to be the healthcare costs. So we've created a tool to help participants to really educate them. I think the common theme that's gone throughout this discussion, both from Paul and Rick, is that there's an opportunity here to help educate participants on what a great savings vehicle an HSA can be. There's a lot of misunderstandings about HSAs. As I mentioned, participants still see it as a use it or lose it. They don't necessarily understand it's their own account. They don't understand that they can invest in more than cash accounts, money markets, that they can actually invest that money into mutual funds. And Empower created a tool, and I know other record keepers are going to be following suit and doing something similar, because this is really the next evolution in retirement savings, is try to bring together health and wealth and provide an overall more holistic picture for participants. So when a participant goes out to our experience, you're going to see there's a single sign-on. In the upper right-hand corner, they're going to show their total account balance. Can you guys see that, Paul, Rick?
Yes, you're good. Go ahead.
Great. So there's the upper right-hand corner, you can see that participants can see their total account balance. It's got the 401k assets as well as their HSA assets all incorporated into their total account. So what it does is stress to the participant that this is a savings vehicle, and starts to get participants start asking why. Why is the HSA incorporated here on my website? And help them start understand that it's really a savings vehicle, can be used for retirement savings down the road. What Empower does is we take that savings account balance, is we convert it into a monthly income number for participants throughout their retirement years. So we're going to show them what their monthly income is based on their overall savings in the retirement plan for the remainder of their life, from their retirement age throughout the remainder of their life. So you can see here with Taylor Smith, the sample person here, her account balance is at $25,482. $23,000, a little over $23,000 is made up by the 401k. The HSA makes up a little less than $2,500 of that overall savings. And then we convert that number into the various components, whether it's our savings, employer contribution. But what I want to highlight is here we can also see it as their HSA has an impact on the retirement savings. Because again, we're getting back to what we've been saying all along, is that what we really need to do is help participants to understand and educate them on this tremendous savings vehicle that's really truly underutilized. So within our experience, participants can go out here, they can see single sign-on, they can see the HSA as well as the 401k. They don't have to create any link. It's built automatically into the system if a plan sponsor elects to use the Empower HSA with our platform. It also gives the participants the opportunity to change their 401k contributions and see the impact on their overall retirement savings. So when I move the before tax savings button from 4 to 8%, you can see that per monthly income went up to almost $3,000. And we're going to show them what that result's going to be to that participant. But we're also going to give them the opportunity to change their HSA contributions. And they can see what that does to actually change their overall retirement savings. And a participant can review these changes and very simply review those, hit submit, we capture that information and pass it on to the payroll person, whether it's at the plan sponsor or the payroll company if we have a bridge set up. But the point of this is it allows participants to say, okay, well, what if I do increase my HSA contributions? It's actually going to have an impact on my overall retirement savings. It's going to impact my projected monthly retirement income, and it's going to reduce my pay by this. They can review those changes and submit that, and we capture, we send it on to the payroll person. In addition to that, we're going to highlight here, if you see this tab on HSA, we're going to highlight the triple tax savings. A lot of participants don't understand that triple tax savings. We've said a number of times. There is no better savings vehicle truly than an HSA, because majority of participants are going to have enough qualified medical expenses during their retirement years. And those dollars won't be taxed as long as you use it for qualified medical expenses. And 401k dollars will get taxed, whether it's going in as a Roth or coming out as traditional tax deferred. In addition to that, we have a tool up here that's going to show projected healthcare costs for participants. So you can see here, this participant at age 65 is going to have a projected healthcare cost of roughly $872 a month, and our HSA is going to offset about $90 of that. This participant can still play around with the slider down below and say, okay, what if I increase my HSA savings today? How can that be used to offset my future healthcare costs at retirement? And we actually showed a participant, we break it down by the various components, whether it's for their doctor or prescriptions, and a participant can actually personalize this experience depending on their own healthcare costs, whether it's they're a smoker or high cholesterol, cancer survivor, as well as what state they plan to retirement. So it gives them an opportunity to see where their healthcare costs will be during their retirement years, because one of the challenges that we see in this country as participants don't know how to budget for healthcare costs during those retirement years. And this gives them an opportunity to see that, but also see how an HSA can be used to offset future healthcare costs during those retirement years. So the nice thing for a participant, gives them single sign-on, gives them the opportunity to change their HSA contributions. They can see that they can actually change it throughout the year. Unlike an FSA, which is an annual election, the HSA can be changed throughout the year. It gives the participants to see the triple tax savings. And from a plan sponsor standpoint, it allows them to set this up with a single contribution file. So all they do is add the HSA along with the 401k and remit it to us. So it makes it a little easier for them for an administrative standpoint. So the overall perspective is to give the participants a better tool so they start asking questions and become a little bit more informed on what a great tool this can be for participants to save for healthcare costs down the road.
Hey, Dave.
Yes.
Hey, I just want to interject. I think this is a great opportunity just to remind everybody that this, it's one thing to have this stuff on the website, but it really needs to be incorporated into Rick's previous comments. It really needs to be incorporated into an ongoing educational process. And when I start thinking about who's responsible for the retirement education, the investment education, that usually falls on the investment advisor. So if you can begin kind of incorporating the HSA information into the 401k investments, that whole educational spiel that we're doing with participants, whether it's every quarter, every year, but anyway, periodically, then I think and we can keep referring back to the website and encouraging participants to go back to the website. I think that's the way you really drive this whole discussion and understanding with participants. And you have some other great slides. I'd like for you to make sure you get to those other slides because just some interesting statistics.
So Abby, do you want to take over control again and get us back to the original presentation? So I started to say that I mentioned that Paul mentioned I've been doing this for 24 years, and it's interesting to see how the market has evolved. Early on in my career, we spent a lot of time doing exactly what Paul said, educating employees on what tax-deferred savings was and trying to encourage participants to put money away on a tax-free basis for their retirement savings, because at that point was really when participants were involved in more of a consumer-based, consumer-driven retirement savings market. So it's interesting that now participants kind of grasp that. I think we've got a pretty better understanding, and it feels like we're kind of in the same boat today with HSAs, but I think the learning curve will be quicker. The challenge is that HSAs, unlike 401ks, participants make that election every year, and the nomenclature between an FSA and an HSA confuses people. So a lot of participants still see it as it's a use it or lose it, and I'm going to show you some stats on that in a moment. In addition to that, when I'm out talking to plan sponsors about this, it's not surprising that a lot of the committee members, 401k committee members, will tell me, I put away $2,000 a year in my HSA because that's roughly what I spend on my medical costs in a year. And I always come back with, well, in our household, we put away the full $7,000. Even if I'm going to spend $2,000, I take that additional $5,000 in tax-free savings and plow it for future savings down the road. So there's certainly, as we've hit this a number of times, there's an opportunity to help educate participants on the value of these. Next slide, Abby. And we believe that there's a hierarchy in the savings, and participants should really, what they should do is maximize the employer contribution to match. They should maximize the match on the 401k. Once they do that, they should then maximize the HSA to the best of their ability. Once they get past the maximum amount that they do on HSA, they should come back to their 401k savings. Because as I mentioned a moment ago, one of the biggest concerns for participants in retirement years is healthcare costs. It's better to pay off those healthcare costs with tax-free dollars as opposed to tax-deferred or tax dollars that were taxed early in their career. Next slide, Abby. We know that there's a lot of growing interest in the HSA, so you can see that there's more participants are interested, but there's definitely a lot of misconceptions about them. Next slide, Abby. Specifically, 22% of participants don't realize that there's triple tax savings. That's 1 in 5 employees don't understand that the HSA is triple tax savings, which is a better vehicle than I mentioned with the 401k. And 1 in 3 employees don't understand it's their own account. I have a client here locally, a large client, that pre-funds their HSA, their high deductible plan with an HSA, $500 per employee, and every December their employees hurry up and spend it because they're afraid that they're going to lose it because they think it's their employer's money and it's not their own. So that's certainly an area that we can help educate employees that, hey, you put that money in there, your employer puts that money in it, it's yours to continue to grow. And more than half the folks in this country still believe it's a use it or lose it. Again, it's the misnomer, the nomenclature between an FSA and an HSA. I always say in a final presentation that the S in HSA stands for savings. It's a health savings account. The S in FSA is for spending, flexible spending account. And we got to get participants to understand that difference. And 3/4 of this country still use the HSA as really a checking account for their claims for that year. And for some participants, that's just how it has to be. But for a lot of folks that don't really understand that it can be used for more than that, it can save above and beyond that $1,000 or $2,000 that they have in claims a year is something that we need to do as a country to help participants so they're better prepared when they get to the retirement years. I think that's about it for me, Paul. I mean,
hey Dave,
if you want.
Hey Dave, yeah, I have a quick question, Dave, and I you might have just skipped over it, but I just wanted to ask the question because I think I know the answer. You didn't really touch on investments, but if folks, at what point should folks that are using HSAs begin to think about, okay, I've got enough set aside for out-of-pocket medical emergencies. Now I've got this excess amount, and how do I invest that? And if I'm on a platform like Empowers, do I have access to the same investment lineup as the 401k, or how does that work? I know there are a little bit different types of accounts, but are you able to coordinate all of that?
So it's a good question, Paul. The most HSA providers will provide that limit for participants automatically because for our experience, participants have to hold the first $2,000 in cash. So the first $2,000 is held in cash. That will limit their ability to invest all their money. So there's money going to be set aside if claims have to be paid. Any dollar above that can be invested in mutual funds. And if they go to the website, and I apologize, I didn't get to there's a link that gets participants out to the investment options they have. There's a basket of about 20 or 25 funds with the Empower system where participants can invest in mutual funds above that $2,000 threshold. At some point, I believe these will become ERISA plans. And when that happens, I think you'll find that the 401k investments and the HSA investments will be the same. We're not there yet, but I think at some point it will make it easier for participants because then they can make one investment decision over all the different types of money sources that they have. And when I say money source, I'm talking about rollover, deferral, employer contribution, and HSA. So it just makes it easier. And investing for participants can be daunting. So we want to streamline that to make it as easy as possible.
Exactly. All right. I guess that go ahead, Rick.
I was just going to interject too that it's important for employers to remember when they're encouraging their employees to contribute to their HSA accounts, it's also saving them in the payroll tax.
That's a great point. Great point. All right. So at this point, Abby and Imani, I think we're ready to see if we have any questions out there or if anything has come through the chat function. Do we have any?
We do. So this first question here, and you guys have already addressed that, kind of clarified earlier, but it says, so max could be 4550 or 9100. If single HDHP, then you would not qualify for extra 1,000 if spouse is over 55, right? Just yourself. So I think they just wanted some clarification with that.
Rick, you want me to handle that one, or you want to handle it?
Yeah, since I butchered the lower deductible amount.
I couldn't hear what you said, but I'll go ahead. So if you're married and you've got a joint account, if you've got family coverage, then you're going to have the 7,100 contribution maximum for 2020. And if you're age 55 or over, you can do an additional 1,000. And if your spouse is also 55 or older. And we just, as a family, went through this, my wife and I. So I'm very familiar with it. You can add another 1,000. Now, the interesting thing is the Internal Revenue Code limits the maximum amount. And I don't know if it's the Internal Revenue Code or if it's just the way the banks have things set up, but most banks will not let you contribute more than 7,100 plus the 1,000 catch-up. So I had to go working with the bank or the custodian for our HSA accounts. I had to set up a separate HSA account, and I make those contributions to my account in an after-tax way. In other words, I can't do it through I do it through salary deferral, but I can't because I'm not the participant. My wife is the participant in the high deductible health plan. To Rick's comments previously, because I'm not a participant in the Rea Associates high deductible health plan, I have to make my contributions, which are done via direct deposit through payroll deduction, but they're done on an after-tax basis. So I'm not getting that payroll deduction. Now I still get the deduction on my 1040, but I have to take the deduction on my 1040. That's where the income tax savings shows up. But in terms of my wife's salary and tax savings, she's deferring everything on a pre-tax basis all the way up to the 8,100. So that's kind of, and then if you're hadn't really addressed, but if you're in the if you're single, if you've got single coverage, then obviously your limit is going to be half of the 7,100. But if you're over age 55, you can do the 1,000, the extra 1,000. Hopefully that answers the question. It is a little confusing.
Great, thank you. So the next question we have here is any time limit to reimburse for qualified expenses?
Not at this point in time. Not at this point. That's one of the things I always worry about the IRS changing, because it's a little liberal and they are taking away a few things like being able to get over-the-counter medication, for example. So at this point, there's no statutory limitation, and you can save your receipts and take it out at any time.
Yeah, and most HSA providers will allow you to warehouse the receipts with them. You know, snapshot through an app, the receipt, and they'll just hold on to them and they'll do the accounting for you.
Great. I have another question here, and it says, when an HSA owner dies, does the remaining HSA assets pass tax-free to an HSA for the named beneficiaries, or must the funds be withdrawn from the HSA and distributed as cash to the beneficiaries? Is there a limit on the number of beneficiaries? And let me know if you need me to repeat that.
My guess is that probably falls into my area of expertise, and I don't have an answer for that. That just shows you how now, Dave, I don't know if you've got some thoughts on it. I could definitely research it and get back with the person, but if you've got an answer, Dave, that'd be great.
Yeah, if your beneficiary is your spouse, that can be passed on to your spouse with no tax implications. If it's not your spouse, it can be passed on another beneficiary, and it's going to be taxed as income.
All right. Perfect. Thank you.
So the next question I have here is, can you use the HSA for medical expenses also be at the age of 60?
You're breaking up on that.
Yeah, can you repeat that?
I will jump in here.
Sure.
It says, can you use your HSA funds for medical expenses that were made prior to being on an HDHP?
No. The date the account is open, after that point in time, the expenses are qualified, but you have to have the account open prior to any expenses being filed.
That's a good point. So the sooner you open up the HSA account, the better.
Very good. Thank you. All right. Our next one here is, how are S Corp shareholder employees handled for pre-tax treatment of contributions?
My knowledge, it would be the same way, Abby. There's no difference.
Is it true that in 2020 with the CARES Act, you do not have to have a high deductible plan in order to contribute to an HSA?
I've never heard that.
Yeah, I would agree. There's been discussions about it, but I've not heard of anything passed.
I'm not aware either, and I'm pretty familiar with that legislation.
Yeah.
All right, at this time, it looks like there's no other questions, but we can give a few more minutes to, if you do have any additional questions, please submit them in the questions area of your webinar doc right now.
And Abby, I will go ahead and just offer a few closing comments. I want to thank everybody for tuning in today and for participating. I want to thank Rick and Dave for your participation as well. I really appreciate having your areas of expertise represented today. I do think it's, as I said at the beginning, a multidisciplinary approach. If anybody in the audience is interested in that article that I mentioned, that was kind of the inspiration for today's webcast, let me know. I'm happy to send you a link to that. Again, that was, the name of the article was HSA, the Ultimate Retirement Savings Tool. And the three authors, I didn't mention the authors before, but it's Shelby George, Kelly Long, and Karen Retker. You can probably Google that. You'll find it pretty quickly. But if you'd like me to send you a link, don't hesitate to shoot me an email, and I'll provide that for you. It's not a long article, and it does a nice job kind of summarizing what we've talked about today. I'm going to check that. Any final comments, Rick, from you or Dave? Abby, any final Q&A?
There is no Q&A. Oh, wait, we just had one pop in. A few years ago, the HSA program almost ended with Obamacare. Is it secure going forward?
You know, if you don't mind, I'll take that one. I actually tell people that if you take a look at the ACA, all the limits are designed around the same as health savings accounts. So I never felt they're in jeopardy. With the amount of money that is in the market, in the economy, if you will, in HSA accounts, and the fact that if you take a look again at the out-of-pocket deductibles, they were designed around the same maximums for ACA as they were already given to HSA. I personally think they're very safe. They may adapt and change, but I don't see anything coming down the pipe that would scare me about it.
I would say that it's definitely a trend is heading in that direction. And every time I do a presentation of plan sponsor, they're either in a high deductible plan or seriously considering adding one. So it just seems like the trend's heading that direction. So I would say I would agree with Rick.
All right, and one more. Should you not apply for Medicare until your HSA is depleted?
Go ahead, Rick.
You know, again, the Medicare question is tough because you're actively at work and you're getting Part A. You don't even know you have Part A. You're not qualified for the account. So I don't think you should ever deplete your account. Remember that your account is always in your name and the money's always your only rule is you have to have a qualified health plan to contribute any more money to the account. So at retirement, you would have a large amount of money, hopefully, in this account, even though you're not attached because you're on Medicare, and then spend it down on these expenses throughout your retirement. So depleting the account would never be a good idea unless it was necessary.
Very good. And we'll end on this last one here. Do you need to offer the HSA to all employees?
Go ahead, Rick.
I mean, anytime you can through the Labor Department, as long as you can class scenarios or benefit designs. I certainly would recommend offering it for everybody. I have seen, as long as you're not breaking any highly complicated rules, some different contributions by classes. But again, you have to make sure you're not breaking any of the Department of Labor rules, any of the highly compensated rules, and you have to be consistent among classes and groups. Would you guys agree with that?
Yeah. This is Paul. I would agree with that. You need to treat people in each class the same way, and then there's some overall non-discrimination rules that you need to be concerned about. But I would say, in my experience, Rick, and maybe you can share your experience is even better than mine. But most of our clients are not they're providing the same level of benefit in terms of the HSA to all of their employees that are eligible or that are participating in the high deductible health plan. They're not doing a whole lot of targeting of benefits between different classes. Is that your experience?
That is my experience, but remember that there's two ways to contribute to HSA: the employer and or the employee. The other thing is wage can be discretionary. So if I want to increase wage, I can do so as an employer, and they can choose to contribute more to their HSA versus me as an employer contributing a different amount in an employee's account versus another employee. So that might be a little way around that question. Consistent amongst the employer contribution into the account, but you don't have to be consistent amongst wages and themselves.
Yeah, that's a good point. I was really speaking from the employer contribution perspective. All right, I can see we're at 11. Yeah, we're at 11 o'clock now, Abby.
Thank you.
I want to make sure we don't run over. So
Yep.
I don't know if Abby, do you have any final comments? Or do you want me to wrap it up?
I will wrap it up for you guys.
Okay,
Thank you for today's webinar on how to maximize tax savings with HSAs. We hope the team was able to provide you with some valuable insights in regards to best practices and potential solutions. If you sign off today and realize that you have additional questions, you're always welcome to reach out to Dave, Rick, or Paul directly. Thank you again, and we hope you have a wonderful rest of your day.